All right, let's talk about flipping houses in 2026. You've seen the headlines, right? Interest rates are dropping, and you're probably thinking, okay, this is it. This is my shot. But what if I told you that all that good news is actually your single biggest problem? Today, we're going to break down why this market is an absolute minefield for investors, and more importantly, how the pros are completely changing the game to win. Let's dive in.
So here's the number that's got everyone buzzing. As of January 2nd, 2026, the average 30-year fixed mortgage rate hit 6.16%. Now, for the average person buying a home, that sounds fantastic, right? It feels like the market's finally breathing again. But for a house flipper, that number is the start of a massive headache. So that's the big question we have to ask. Is this drop in rates really a green light for you to go all in, or is it a giant flashing warning sign that you'd better pay attention to? Well, the answer is a lot more complicated than you might think, and it really gets to the heart of the battle being fought in real estate right now.
And that brings us to the core problem here. We're looking at a classic double-edged sword, because even though those lower rates seem like they should help, what they actually do is create a whole new set of brutal challenges for anyone trying to find a profitable flip.
You know, Hector Amendola from Panorama Mortgage Group just nails it with this quote. Lower rates don't just help you, they help everybody. All of a sudden, that rate drop is like a dinner bell ringing for every first-time homebuyer and every amateur who's ever watched a flipping show on TV. They all rush to the same auctions, and you're all fighting over the exact same property.
And here's what that looks like in the real world. It's brutal. The data shows investors are paying a record-high median price, almost $260,000, just to get in the door. But look at that other bar. At the exact same time, their gross profit has cratered by nearly 14%. So let that sink in. You're paying more than ever to buy, and you're walking away with less than ever.
This whole situation has created what we're calling the flipper's squeeze. That space, that gap between what you buy for and what you sell for, it's getting thinner and thinner. Let's really dig into the hard numbers behind this struggle.
Okay, take a good look at this number, 25.1%. That's the gross return on investment for a flip right now. But here's the kicker, the part that should really make you sit up and pay attention. The last time profits were this low was 2008. Yeah, right in the thick of the great financial crisis. That's how tough things are out there.
This table just breaks my heart, but it tells the truth. You look at that gross profit, over 65 grand, and you think, hey, not bad. But then reality hits. That profit gets vaporized. Almost $80,000 for the renovation, the insurance, the taxes, the loan payments. Then boom, another $21,000 in selling costs. That big, beautiful number, it just melts away.
Okay, so the bad news is the margins are razor thin and the competition is absolutely insane. So how do you fight back? How do you win? Well, the first and most critical tool in your 2026 playbook is financing. In a market this tight, the way you fund your deal can literally make or break the entire thing. So how do you get the cash? You've got a whole arsenal of options, and picking the right one is crucial. You could tap into the equity of your own home, or you can go for these specialized investor-focused loans that are built for speed. Let's break down a couple of the key differences.
Let's compare two of the big guns for serious investors. Hard money loans are all about speed. Think of it as the speedboat of funding. You can get cash in as little as a week to jump on a deal, but you're going to pay a higher price for that speed. Rehab loans, on the other hand, are more structured. They're based on the future value of the house, which can be amazing for managing your cash on those bigger, more complex projects.
And if you're thinking about using your own home to fund a flip, these are your two main doors. A cash-out refi gives you one big lump sum of cash. A HELOC is more like a credit card, a flexible line you can draw on when you need it. But here's the thing you cannot forget, they both carry the exact same massive risk. If your flip goes south, it's not just a business loss. You could lose your own home.
Okay, so nailing your financing is only half the battle. You absolutely have to know your market inside and out. And to really show you what I mean, let's take a deep dive into one of the most dynamic, most talked about, and most volatile markets in the entire country, Las Vegas.
So, before we can talk about Vegas, you need to understand this one key metric: months of inventory. All it really is a pulse check on supply and demand. Right now, Vegas is sitting at 4.6 months. That puts it smack in the middle of a balanced market. It's not crazy hot, it's not ice cold, which means it is full of conflicting signals.
So why are people so bullish on Vegas? I mean, the city is transforming. It's not just about the Strip anymore. You've got massive pro sports expansion, a booming tech scene, a new medical school creating high-paying jobs, not to mention huge infrastructure projects. All the signs are pointing towards serious long-term growth. But there's always a but, right? And here's the bear case, the reasons to be super cautious. Vegas real estate is famously a roller coaster. And get this, big-time institutional investors, we're talking Wall Street funds, already own 15% of the homes there. That means they can move the market and outbid you on almost any deal they want. You've got to weigh that explosive potential against some very, very real risks.
So we've looked at the profit squeeze, the financing maze, and the chaos of a market like Vegas. So the big question is, what do you actually do? How do you put together a strategy that actually wins in 2026?
Here it is. This is the 3-step playbook for this new world. First, master your numbers. And I don't just mean your rehab budget. I mean next-level risk management, like checking for potential lawsuits or torts, and using legal tools like UC Article 9 filings to protect your capital. Second, secure your funding before you even think about looking for a deal. Speed is everything. And third, and this is the real game changer, know your market so deeply that you get there first. The pros are done with auctions. The winning move now is to go upstream, find the deals, and talk to owners before a property ever hits the open market. You have to avoid the bidding wars entirely.
And that really brings us to the final thought here. In a market this competitive, with margins this thin, the biggest risk isn't that you'll make a mistake on a deal. No. The biggest risk is a lack of preparation. Not having your funding ready, not having your capital legally protected, and not having a strategy to find deals before everyone else. So the real question is, are you ready?